What if one price tag could rattle every economy on Earth? Oil at $100 isn't just a number, it's a global tipping point. Every $1 rise in oil adds up to $80 billion a year in extra costs for importing countries. Imagine that suddenly doubling or even tripling.
Wait. $80 billion times 30 is around 2.4 trillion?
The last time oil spiked past $100, inflation surged, the economy stumbled, and financial markets panicked. Right now, oil is hovering around 78, but tensions in the Middle East are building pressure fast. Experts warn that just one major disruption and prices could explode to $120, $50, even $300 per barrel. This isn't some far-off scenario. In fact, 20% of global oil flows through one vulnerable choke point, the Strait of Hormuz. If that shuts down, even briefly, it could send shockwaves worldwide. Hit a like button, subscribe, and let's find out what happens if oil hits $100 again. Who wins, who loses, and how bad could it get? Right now, oil prices have jumped 7–13%. But here is the catch. It's not because pipelines or refineries were damaged, it's all about fear and uncertainty. Investors are paying a premium simply to hedge against what could happen. So far, Iran's oil infrastructure remains untouched, meaning actual supply hasn't dropped. But if either side targets key facilities, the market could react violently, pushing prices through the roof.
To put this in perspective, Iran exports nearly 2 million barrels per day, about 2% of global supply. That may not sound like much, but even small supply interruptions historically cause big ripples. Back in 1973, a 4% supply cut quadrupled oil prices. The real danger? The Strait of Hormuz. This narrow passage handles about 20% of the world's oil trade, roughly 18 to 20 million barrels daily. Iran has the capability to raise insurance costs so high that commercial shipping could stop voluntarily, even without direct attacks. That means prices could skyrocket beyond the current $78, potentially hitting 100 to 120 fast if tensions escalate.
The difference between fear and reality could be the difference between manageable price moves and full-blown market chaos. What do you think? Can panic move markets faster than missiles? Share your thoughts in the comments below. The Strait of Hormuz is one of the most critical choke points in global energy trade. About 20% of the world's oil passes through this narrow waterway every day, fueling economies across the globe from Asia to Europe and Americas.
Because so much oil relies on this single route, any threat to its accessibility immediately sends shockwaves through the markets. Even the possibility of a disruption here can cause oil prices to jump dramatically. Analysts warn that if the strait were to be blocked, even partially, oil prices could surge as high as $200 to $300 per barrel, levels unseen in recent decades. This kind of price spike would ripple far beyond just energy markets, shaking financial systems, increasing costs for everyday consumers, and threatening global economic growth. The mechanism behind this isn't just the physical stoppage of oil shipments. Iran's military capabilities, including mines, drones, and missiles, create what experts call insurance risk. This means that commercial shipping companies might choose to avoid the area altogether, not because of direct attacks, but because insurance premiums and security concerns make transit too costly or dangerous.
So far, the markets has responded cautiously, with Brent crude hovering around $78 per barrel, but history shows us that even brief interruptions in this vital corridor can have outsized impacts. The world economy is effectively holding its breath, knowing that the fate of oil prices and much more could hinge on what happens in this narrow strategic passage. Since the 1970s, every major surge in oil prices has triggered significant economic consequences. Especially in the United States, when oil prices spike sharply, they act like a hidden tax on consumers and businesses, driving up costs across the board, from transportation to manufacturing and heating. This squeezes household budgets and corporate profits, often pushing the economy into recession.
If oil prices climb above $150 per barrel and stay there for months, economists warn we could see a sharp slowdown in economic growth combined with rising inflation, a dangerous mix known as stagflation. Historically, this scenario leads to reduced consumer spending, layoffs, and stalled investment, creating a ripple effect that spreads far beyond the energy sector. The stock market often feels the impact first. During previous oil shocks, stock indices dropped by 20 to 50% as investors pull back from riskier assets amid uncertainty. The pain doesn't stop at Wall Street either. Global markets typically follow, and many emerging economies dependent on affordable energy face even steeper challenges. With inflation climbing, central banks may face tough decisions on interest rates, further complicating economic recovery.
The financial domino effect of high oil prices is clear. It threatens global prosperity and stability, making the $100 oil question not just about energy, but about the health of the world economy itself. When oil prices hit $100 or more, the global economic landscape shifts dramatically, creating clear winners and losers.
On the winning side are oil-producing countries like Saudi Arabia, Russia, Nigeria, and others. These nations stand to boost government revenues significantly, helping repair budget deficits and current account imbalances. With increased cash flow, they can invest more in infrastructure, social programs, and economic diversification, strengthening their long-term growth prospects.
The economic diversification in Russia looks like this.
Higher oil revenues often translate into stronger currencies and greater geopolitical influence, as these countries reap the benefits of elevated global demand for their resources. On the other hand, countries heavily reliant on oil imports face serious challenges. Nations such as India, Turkey, and Ukraine, which already struggle with fiscal and current account deficits, could experience rising inflation and capital flight as their currencies weaken. For these importers, higher energy costs squeeze household budgets, raise production costs, and stoke inflationary pressures. Governments and central banks must then grapple with difficult policy choices, raising interest rates to defend currencies and control inflation, or risking slower growth and financial instability by keeping rates low.